What's up, everybody, and welcome back to MF1 Dividend Investing. This is going to be episode 7. Today, we are going to talk about dollar cost averaging. This is what I use to fund my account, or the way I go about funding my account in M1 Finance. So I figured I would just go through it and explain why I use it and how it's kind of a bit on steroids with M1 Finance. With that said, please like and subscribe to this video so I can bring you some more. Let's jump into this. Okay, so first things first, let's just give you a basic definition of what dollar cost averaging is. So here we go. Dollar cost averaging is an investment strategy in which an investor divides up the total amount to be invested across periodic purchases of a target asset in an effort to reduce the impact of volatility on the overall purchase. So what does that mean in layman's terms? It basically means that you are going to be investing on a set schedule, a certain fixed dollar amount, and you're going to invest no matter what the conditions are in the market. If the market goes up, you're still investing the same amount of money. If the market goes down, you're still investing the same amount of money. So essentially, right here it is, right? You invest a set amount of money into the market on a standard schedule, regardless of market conditions. Why would you do this, right? Well, one, you're not timing the market or trying to time the market, so it takes the headache out of that. No one can really pick the market 100% all the time, so this is kind of an easier way to kind of average in up or down into your positions and not have to worry so much that you're timing it perfect to kind of make the most of the purchase. Second, it takes a bit of the emotion out of your purchases, right? So a lot of times investors get into trouble because their emotions get the best of them. So, they may buy something, perfect example, I guess, right? The COVID-19. They may buy something January 2020. 2 months later, right, everything crashes. You're down 40-50% on your portfolio, and you panic sell, and you get out too early, and then you miss the whole recovery. Now, if you were dollar cost averaging and you're only putting a little bit of money in each week or each month, right, 2 months in, you're okay, right? You don't have that much money into the stocks yet, and you keep going, right? As it goes down, you keep buying more, and even as it goes up with recovery, you're continuing to buy. And then the last thing that kind of gets lost with dollar cost averaging, I think, when people try to compare it to lump sum investing, is you got to have the money up front when you lump sum invest, right? If you're going to put all your money, if you have, if you're going to have two accounts and compare them, and one's got, both of them are $100,000 per portfolio. With the lump sum, you need the 100,000 up front. I don't think most people have $100,000 kind of laying around, or even $10,000. So in general, you're dollar cost averaging just out of necessity because you don't have a big pool of money saved up that you're going to invest. In general, I think most people are dollar cost averaging. So let's see just a quick example that I put together of two portfolios based on last year that basically will show you the differences between lump sum investing versus dollar cost averaging, which one comes out ahead based on different scenarios. Again, it's just an example to show you. I'm not trying to say that you can't have a portfolio that's better with lump sum, or you can't have a portfolio that's better with dollar cost averaging. I just want to show you an example between the two. So let's jump into that. Okay, so up on the screen here, you're going to see a chart that's got a 5-stock portfolio, and this runs from January 2020 through December, end of the year 2020. Assuming you bought these throughout the year, if you're dollar cost averaging, or if you lump sum, it assumes that you bought everything on the first trading day of the year, which was January 2nd, 2020. The 5-stock portfolio is Apple, Johnson & Johnson, 3M, Coca-Cola, and Visa. Just looking at the chart, right, you can see here they all started the year off not too bad, aside from 3M, and then in March, everybody was down pretty significantly. The max here looks like 34% by 3M from the January starting price, and then the recovery kicked in, and everybody came out of this recovery. Some better than others, obviously, and Apple ran away with it. And you can see at the end of the year, Apple was up nearly 80% from the start of the year. So now, if you had this 5-stock portfolio Let's just show you an example of basically, whether if you lump sum invested that money or dollar cost averaged over the year, where would you fall? Where would you end up? So let's assume, for the sake of this, that for your lump sum portfolio, you invested $3,000 in each of these stocks for a total of $15,000. You invested this money on January 2nd, 2020, right? Here's the amount of shares that you're able to buy of each of these stocks based on their ticker price at that day. And basically everything you see here to the left is all the backup that is used for this. So you can see here, right? You got, Visa on January 2nd, 191. So that's the price that you bought it at. Here's the dividends that you received throughout the year. In total, it was 320. And then your ending investment. So this is what the portfolio was worth at the end of the year, based on the stock price at that time, which would be December 31st, 2020. So you started with 15, you ended with 17,848. When you add the dividends to that, your grand total would be $18,169. for a total gain of $3,169.65. Overall, you did pretty well for the year. You were up 21.13%. If you back out the dividends, that's almost a 19% gain. And then going forward, if you kept the exact same shares that you had at the start of the year, due to the dividend increases, you have a little bit more money in forward dividend income at $323 instead of $320. So that's your basic lump sum portfolio. Everything went in the beginning of the year. You didn't even have to check your portfolio the entire year. End of the year, you look at it, and this is what you end up with. Now let's look at if you were to dollar cost average that over the course of the year. So for this setup, I dollar cost averaged on a set schedule of once a month. So you can see kind of here, right? Dollar cost average, the ticker, right? We're going to spend the same amount of money overall, $15,000. So $3,000 a month. A year for each of these, which works out to be $250 a month invested. So every month, right, you're buying $250 worth of each of these 5 stocks. And you can see that goes through for the entire year. And these are the amount of shares you're getting per buy for each month. So with that aside, here's the shares you end up with at the end of the year. Here's your dividends you get throughout the year. You'll notice that your dividends are significantly less than if you were to lump sum invest, which is pretty obvious, right? If you're buying throughout the year, you just don't have as many shares as you do if you bought everything up front. So you are going to miss a couple dividend payments. But in the end, it will end up working out usually in your favor. Here's the ending value of your account, $17,893. Total when you add in the dividends, $18,097.63. And your total gain for the year, $3,097.63 for a percentage gain of 20%, 20.65%. And if you back out the dividends, you're at 19.29%. So if you look at this and just compare it to the lump sum, you almost are equal, right? Whether you had all that money up front and dumped it in, or you did it little by little throughout the year, you ended up in the same place, give or take less than $100. So really not too bad. Interesting thing, right? If you go by percentage chain overall, because you got more dividends in the lump sum account, you ended up with slightly more, right? 21 to 20. But if you back out the dividends, you actually were slightly up more on the dollar cost averaging portfolio at 19.29% versus the 18.99% that the lump sum portfolio had. And then forward dividend yield, because you were able to buy a couple more shares of these 5 companies with dollar cost averaging, at the end of the day, you had a slight gain in forward dividend income at $324 versus $323. So as you can see, right, either one works. I think, in this scenario, we just bought on the first day of the year, but assuming you were trying to time the market, you didn't have to worry about it. You just bought it, right, every month blindly, whether it was up or down, and you would end up about the same. The one thing I want to show you here, though, where dollar cost averaging is kind of beneficial and also kind of where it can hurt you, is by looking at the individual stocks. So I purposely put Apple in here because Apple ran like crazy. And this is one place where you'll lose out short term, right? If you're looking at a year or two out, if you get a stock that's just going to run on a tear, obviously you want to get in on that stock early before it runs. And if it just continues to go up and doesn't go down, or very rarely goes down, you're going to do better, right? Putting the money in right in the beginning. But again, you have to kind of anticipate that, know that, and in a way that's very difficult to do. Second, very rarely are you going to get returns of, close to 80% a year on any individual stock. So in general, it's not typical. But I wanted to show you an example that, this is where dollar cost averaging fails, but I'll show you where it exceeds also. So in Apple, right, we put $3,000 in up front, first day of the year. You got almost 40 shares. We collected the dividends. At the end of the year, it was worth over $5,000. We had a gain of over $2,000, right, for a percentage gain of 79%. Incredible, right? If we got that every year, we'd be retired real soon. So atypical, but we did really well. Let's see how we did with dollar cost averaging, right? You go down to the dollar cost averaging portfolio, you look at Apple, and the gains here were much less, right? Only 1,500. And the percentage gain was 52%. So you had 79 versus 52%. So obviously you got kind of killed a bit with Apple here, and you lost out on some games by using the dollar cost averaging. So this is an example, right, where you could have an issue if you're on a tear and have a bunch of stocks that are running up in value incredibly fast. You're going to lose out on those gains because you're buying as it goes higher and higher and higher instead of buying up everything right in the beginning. But here's the interesting thing. Let's look at these other stocks that we have in the portfolio, right? So the next one on the list is Visa, and Visa didn't do bad for itself either. I know this chart kind of looks a bit skewed because Apple just ran away with it, right, at 80%. So it makes all these other gains look pathetic in reference to it. But Visa didn't do bad either. If you look here, Visa for the year was up over 14%. I would take that no problem, right? So 14% gain over the year, not too bad. And even Johnson & Johnson was up, I think at the end of the year was close to 9%. I can't get it right on the last day, but we can look at it down here and you can see. So here's where it gets interesting, right? Let's look at Visa first. So Visa, lump sum portfolio, you invested the $3,000, right in the beginning. You ended up at the end of the day with 14.89%, right? And 14.25% if you take out the dividends. Now, let's look at dollar cost averaging. Dollar cost averaging, we actually did slightly better, ever so slightly, right? We were at a 14.9% gain overall. Literally a dollar difference between the two. So there's a perfect example of, even though Visa did very well at a 15%, year-over-year increase, whether you put the money in on the first day or you put your money in, throughout the year, you ended up in the same place. Even more interesting, right? Let's go to the next stock, which is, and Johnson & Johnson was the next on the list with the biggest or third biggest gain for us, right? So lump sum, we were up 9% and almost 7% without the dividend. If we were to go and look at the dollar cost averaging for Johnson & Johnson, right, we ended up with 9.95%, so almost 10%, and 8.25%. So we were over a percentage point better by dollar cost averaging J&J over the course of the year, instead of lump sum investing. And that's where, as you see, when the market is very volatile, you'll have usually a better gain or a better end of the year percentage showing versus lump sum investing, especially in a flat or a down market, right? Because you're buying and lowering your costs as you go through the market, and then eventually when it recovers, you should do much better, right? Because you're not buying and then just holding it throughout at a high price, and then eventually, hopefully, that it'll cross that line and you'll be positive again. In a dollar cost averaging scenario, right, you're buying even as it's going down. So it needs to recover less for you to end up making money. And that kind of shows in the next two stocks. So the next two that we had here were Coca-Cola and 3M. And if you look at these two guys, right, they were both negative on the year, 1% and 3%. So almost flat, essentially. And they did recover a lot from being down over 30%. But they ended the year just slightly negative. And obviously that shows, right, in the lump sum portfolio, right? We bought them in the first of the year. And, Coca-Cola was a little positive when you add the dividend in. 3M basically was flat, but you back out the dividend, and you were down 1% and 3%. Here's where, where we really made up the difference, right? Coca-Cola and 3M at the dollar cost averaging portfolio, right? Bought it throughout the year as it was kind of going up and down a little bit. And you can see here, we actually ended up with Coca-Cola and 3M at 13% and 13.26%. with the dividends. So we beat it by over 10% from the lump sum portfolio. So that's kind of where this dollar cost averaging, shines in a bit of a choppy market where you don't know where it's going to do, or maybe you don't want to try to put in the effort to figure out and see into the future and really do your homework on stuff. Just going in, let's say blindly, right, buying every month, you end up doing pretty good for yourself. The stock overall was flat for the year, but you're up 12%, which is nothing to be upset about. So that's kind of where dollar cost averaging shines a bit, and personally why I use it for my M1 finance account. And the other interesting thing about that, right, I back Apple out to show you that Apple running away, which is atypical, really skews this. So here's Apple, or without Apple, right, the lump sum portfolio, you ended up total for the year 6.6%, right? And you have a forward dividend income of $290. If you go to the dollar cost averaging portfolio, right, without Apple, you invested $12,000 over the course of the year, but you were up 12.77% versus 6. You doubled your performance from a lump sum perspective. And because of that, also, you were able to buy more shares, right? So you have a higher forward dividend income than before. Actually, it's almost 10% more in forward dividend income in the dollar cost averaging portfolio. So in a way, I think the dollar cost averaging kind of hedges your risk a little bit. But mostly in my case, the main reason I'm using it and why I feel it's a good investment style is simply because, I don't have all this money saved up to begin with. I don't think it's valuable for me to save throughout the year and then, let's say on the first of the year, dump in all that money that I would have put in into the market throughout the year. And I don't have to think, okay, is this the perfect time to buy or not, right? We're just going to do it every 2 weeks. So that's a little summary, right, of lump sum versus the dollar cost averaging way of investing. Let me just pull into M1 Finance real quick, and I'll show you how it kind of supercharges that just a little bit. Okay, now that we got my M1 Finance dividend growth portfolio up on the screen, I just want to quickly kind of explain how dollar cost averaging is, in my opinion, souped up a bit with M1 Finance. So as we know, right, M1 Finance has the dynamic buying or purchasing, right? I have all my allocations set for all my stocks, target both on a slice basis and then on the individual stocks themselves. So, when I go to buy a stock, M1 Finance is going to look for my stocks that are underweight per my target allocation and put more of my money that comes in into those stocks, right? So my buys will be in stocks that are underweight from what I want, right? So Skyworks, for example, I'm overweight, right? My target allocation is 9%, and right now I'm sitting at 9.6%. So when I go with my next deposit, it's going to automatically buy stocks that are underweight right now, which is Microsoft, Texas Instruments. So a few of these guys, even Apple is slightly underweight right now. So it'll buy all those. And the way that helps with my dollar cost averaging is it's not buying the guys that are running up high, right? It's buying the companies that are either staying flat or not growing as quick or lower. And I'm okay with that, right? Wouldn't you say, oh, well, like, why wouldn't you pick the winners? Let the winners run, keep buying the winners. The problem with that is a lot of times as companies grow and run away from the pack, they become overvalued. So you don't want to put a lot of your dollars, if you want your dollars to work as hard as they possibly can, especially in a dividend scenario, right, where we're hoping to get, income returns and not just capital returns, right, not just capital gains returns. You want your dollars to work harder. So you would prefer to buy companies that are kind of out of favor or even undervalued, and let them stay undervalued as you continue to buy and buy and buy. The one thing you have to look out for, though, is you have to make sure your portfolio is strong enough that you're not worried, right? So you need to be careful, not just pick a random 100 stocks and then just keep pouring money into the 2 or 3 that are completely underperforming and just keep failing and failing and failing. But if you know and have done your research and have a pretty good confidence level for the companies that you picked, which I feel I do for my account, you shouldn't be worried that, okay, I'm down on Pfizer or I'm down on Gleed, right? These companies, if I need to put more money in, I think they're undervalued right now, and I think they'll eventually come back to fair value, and then I don't mind getting a little more for my money right now, right? Buy a couple more shares and get a little more in dividend income from that instead of buying an overinflated company, which may be wildly overpriced at the moment. So, and getting less dollars or get less dollars in income from my deposit money. So that's kind of how I see M1 Finance supercharging my dollar cost averaging type of investing. With that said, I'll wrap up the video. Thanks for watching. Any questions, leave comments below, like and subscribe, and I'll see you next time.